All the talk for the Federal Reserve is about whether or not they're going to scale back on quantitative easing. Well, to talk about it with us today and how it might play on the gold trade is Scott Carter of Lear Capital. Scott, thanks for being in here.
Thanks for having me, Joe.
So the big question a lot of people are wondering is if the Federal Reserve scales back, what's going to happen to gold? How should they play it?
Well, I think they've been floating these trial balloons for a while, so there's some aspect already baked into the price of gold. But certainly if the Fed seriously scales back, then that will have an effect on liquidity in the marketplace and also on the price of gold. Having said that, though, the price has been hit pretty significantly over the last month, and the whispers on the street are that they are going to pull back. My personal view is they won't. I think that the economy is still weak. I think that the Fed is still going to print money to the tune of $85 billion a month, and I think the federal government needs that right now to help prop up the economy. It's just not doing well yet.
Okay, let's say that on Wednesday when the FOMC comes out with its minute, it doesn't necessarily scale back, but eventually at some point we are going to see, hey, the Fed is scaling back. When that happens, I've had one trader tell me he could see prices dropping as much in the paper markets,
right.
$30, $40, $50.
Right. That wouldn't surprise me at all. $30, $40, $50 is a 2% move.
Yeah.
Gold's been very volatile. That would be expected. It's interesting, Joe, that gold has pulled back 8 times since 2003. So we've kind of seen this movie before. The average pullback over those 8 times is between 15 to 20%. This last one was 34%. Every pullback, though, has seen gold appreciate up to, on average, 40%. We'll see if that happens this time again. But the track record for gold, given the conditions in the marketplace, has been pretty bullish for the last decade.
Mm-hmm. And finally, let's shift into, again, we'll stick to the paper markets, GLD, IAU. We're looking at the ETFs, the gold ETFs. What do you make of the outflows from those right now?
Right. I think that many investors, the Momo crowd, is chasing yield. And right now, when you look at the yield, you can't get it in savings, you can't get it on bonds. Really, the only place you're getting it is in the stock market. So one of the deterrents for gold is the fact that it doesn't pay a dividend, doesn't pay an interest rate. So for a security trade, not the physical asset in the paper market, GLD is a security. It's easy to opt out of that, if you will, to rotate into investments that can get you a higher yield, which is in the equity market. However, if you look at debt, if you look at slow economic growth, if you look at eventually inflation or a pullback due to inflation, you couldn't set the table any better for having gold as a part of your portfolio for diversification. Okay,
and real quickly, next 3 months, a quarter's worth of time, are you telling people to jump into gold or what?
I think gold is at an attractive price right now. Certainly there's still some technical trading that could take us down to 1260. There's a pretty strong floor at 1260 to 1300. But now would be a good time to get in that, and that's what you're seeing at the physical market. But I think you need to have a strong stomach. It's very volatile right now, and that will continue until we get a little bit more of a clear picture over the next 2-3 years. Some of that will be the Fed.
Yeah. Well, Scott, thanks so much.
Thanks for having me, Joe.
You heard Scott. He summed it up very well. If you're buying into gold right now, make sure you have a strong stomach. I'm Joe Deaux, The Street.